Welcome. Today, I want to introduce you to a financial option that combines growth potential with principal protection. FDIC insured structured CDs. Structured CDs are designed to help investors to balance growth and safety, but like any investment, they do come with both benefits and some considerations. So, what is a structured CD? Structured CDs are an alternative to traditional CDs or certificates of deposit, offering FDIC insurance for principal protection while providing the opportunity for returns linked to market index such as the S&P 500. Unlike regular CDs with fixed interest rates, structured CDs allow for returns based on market movements, offering the potential for higher earnings if the market performs well. However, it's also important to understand that structured CDs do come with certain limitations, such as reduced liquidity. Accessing funds before maturity may require selling on the secondary market, which could potentially result in less than the initial investment amount. Some of the pros of structured CDs: number one is the confidence of having that FDIC insurance. One of the main advantages to structured CDs is that they come with FDIC insurance and up to, whatever the applicable limits are, 250,000 usually. And what this means is that if you hold the CD until maturity, your principal is guaranteed and you still don't even have the credit risk of the bank. You have that Federal Deposit Insurance Corporation backing it up. This provides assurance for conservative investors. However, it's still important to note that this protection applies only to the full maturity date. So if you get out early, that might not apply. The enhanced growth potential, and this is really the main reason why we love these. Structured CDs can offer a way to participate in the market without directly investing in stocks. So in some cases, structured CDs may allow you to earn more than the actual market itself. For instance, a structured CD might offer 115% of the S&P 500 growth over a specified term, meaning that if the index does perform well, you could actually exceed the market's performance. However, these terms do vary by product and it depends on what volatility and interest rates are when these are put together. So it's essential to review the terms for each one specifically. The next benefit is diversification. Structured CDs can be a useful tool to diversify your portfolio, and they provide a blend of income security that you get with fixed income, and you all still have that market exposure, allowing investors to add variety to their portfolios. Some of the cons of structured CDs: liquidity constraints. So, like I mentioned, structured CDs are generally a little bit less liquid than traditional CDs. While you can still sell out without paying a penalty, your principal will be subject to whatever the secondary market is pricing it at. So it can fluctuate and you can have a little bit of performance lag until you get closer to the maturity date. This could mean that you might receive less than you actually put into it. It is possible, while not likely. The potential for lower returns. Yes, if the market does underperform, structured CDs could underperform as well. And they could do worse than what a traditional CD with a fixed interest rate could have done. So, if the market tanks and is down 10% over the period while you have your CD, you could have foregone that opportunity and earned, say 4 or 5% on a traditional CD. So that's one of the opportunity costs you face with this sort of investment. The performance of the structured CD, it's tied to the index performance, so they're not guaranteed in any way. That's, another con. Some people would say these are complex products and they maybe have limited availability at certain brokers, so you might have to look around to find someone that specializes in this. Structured CDs can be a little bit more complex than traditional CDs, and not all banks offer them. So, yeah, understanding the terms such as the caps, the gains, the participation rates, it's essential to really know what terms you're dealing with and decide if this is a good deal and if it makes sense for you and your portfolio and your goals. How do these work exactly? When you invest in a structured CD, your returns are typically going to be based on the performance of the market index over a specified period. For the S&P, if it does well, you might earn a percentage of that in some cases, or in more cases that we see these days, you're usually getting 100% of the index's performance, but it could be 80% or it could be 120%. Just depends on the market environment. So you want to look at that closely. Certain structured CDs can offer those enhanced rates. Like I said, 120% is possible, allowing you to benefit from the multiplier effect and the leverage if the market does well. However, even if the market underperforms, your initial principal will be protected by that FDIC insurance as long as the CD is held to maturity. Why would you want to use the S&P 500? You might be wondering, why the S&P 500? Well, It's often chosen as the index for structured CDs because it's the largest 500 companies in the United States. It represents a broad selection of the economy, and it's got all of the biggest companies in the US. By linking the returns to the S&P 500, these structured CDs provide the potential to benefit from the general economic and growth trends. And the S&P 500, it's a very efficient index. When a company performs poorly, like Walgreens, they might remove it. If a company does well, like Tesla, they add it. So you're always going to be on the cutting edge of the latest trends in the market. However, you do want to keep in mind that past performance does not guarantee future results. And a structured CD is not a direct investment in the stock market. Now, one of the interesting things is to think about is the security of FDIC insurance. It's one of the most reassuring aspects of this, and it's what protects your principal. The FDIC, Federal Deposit Insurance Corporation, has a really strong track record of maintaining depositor confidence even during financial crisis. In both the 2008 financial crisis and the 2022 banking crisis, the FDIC was able to step in and make depositors whole in a reasonable amount of time. In this most recent banking crisis, it was over the weekend they had made all their depositors whole with Silicon Valley Bank. So the FDIC is really good at what they do, and they will clean up any mess in the banking industry. So one thing you might want to look at if you're buying a lot of CDs is to make sure that there's a limit to how much you can have. It's usually 250,000, maybe 500,000 for a married couple per ownership category. So if you have an LLC or an IRA account and a trust account, those would be different categories for this. But this added security can make structured CDs appealing to investors who really don't want to lose money. However, they're not for everyone. If you have a short-term horizon or you may need immediate access to your funds, the liquidity constraints of a structured CD could be a drawback. Structured CDs may also carry more complexity, so it's essential to fully understand the terms, including any caps or participation rates on these. If structured CDs sound like they might be a good fit for your investment strategy, feel free to reach out. I'm here to help and help you understand all the details and how these products may or may not align with your financial goals. Thanks so much, and I hope you have a great day.